Good morning, everyone. Welcome to another installment of the Stablecoin Solutions Show, the first and only show on X dedicated to talking all things stablecoins. And there's a lot to talk about. I'm going to go ahead and post the live space so we can try to get some folks to join our live broadcast today. And while I'm doing that, I'm going to also sort of recap what has happened and where you can find more information on all this stuff if you want to know more about what is going on with respect to stablecoins. I run this show every Friday, 9 a.m. Eastern on X. It is available on YouTube for download, and it is also available on Apple and Spotify podcast. We are live. All right. So you can download it after the fact. You can watch it back on YouTube. Also, if you have not yet subscribed to my free guide, Make Your Wallet Your Bank, today would probably be a good day to learn how to make your wallet your bank. My book talks about how to break free from the banking toll booth economy, how to make your wallet your bank, how to eliminate the fees that come with consumers and every step of the way in the banking system. And boy, oh boy, did we see a lot come out of the banking system over the last couple of weeks. We'll start with the biggest news. The Clarity Act went before the Senate Banking Committee on Thursday. They had their markup vote and it passed. This is a huge accomplishment. I've been very vocal about the fact that the Clarity Act is probably the single most important piece of crypto legislation that we have seen get through Congress. It is close to getting over the finish line at this point. Is it a perfect bill? No. No bill is perfect. There are certainly parts of this bill that I'd like to see improved, especially when it comes to, I believe it's Section 301, which talks about the exposure to criminal prosecution for code developers. We saw this play out in the Samurai wallet case and in the Tornado Cash case, which I've covered pretty extensively. And one of the concerns in that provision is that code writers who are in the business of executing code that they may know could be used for illegal activity could be prosecuted under the unlicensed money transmitter provisions of the federal criminal statutes. And that's alarming to a lot of people. So there's a lot of back channel debate going on to try to fix that. There's, of course, the ethics provisions. Look, at the same time, we have a White House that is very, very supportive of digital asset innovation. And we would not be as far as we are right now without the support of this White House. So we cannot discount that. However, at the same time, President Trump and his family's crypto ventures have certainly drawn a lot of interest from legislators and a lot of concern about ethics and conflicts. And they want to bake into the Clarity Act ethics provisions, not only for the Trump family, to be fair, but also to members of Congress, that anyone that has a vested interest in the outcome of crypto legislation should not be able to either directly or indirectly invest and profit from it. Now, we have to take that with a grain of salt because we have seen, and it's been widely reported, that many members of Congress seem to have amazing trading records when it comes to their stock portfolios. And a lot of those same people have a lot of access to inside information. So there is obviously a double standard there, and I don't know why crypto and digital assets are being singled out in this conversation. That was brought up yesterday during the Banking Committee's debate, and it was pushed back on pretty strenuously that there are mechanisms in place to protect against this stuff. The DOJ has the ability to prosecute. Obviously, SEC and CFTC have the ability to investigate this stuff. So that was, again, a real juggernaut in moving this bill forward. But probably the biggest highlight that came out of yesterday was Elizabeth Warren and what can only be described by me, and I think many, her absolute desperation to kill crypto in the United States. She came across pretty much unhinged yesterday. All of her amendments, and I think she proposed like 44 amendments, the ones that did actually make it up for a vote during the markup hearing were all shot down. She was defeated across the board. Let's backtrack a little bit to talk about how we got to Thursday's markup hearing, because that's, I think, very important to talk about. As you know, I've been a very vocal proponent of stablecoins and integration of stablecoins and allowing the consumer market to have choices when it comes to how they custody and how they spend their money. Digital dollars is an extension of that, and digital dollars via fully regulated stablecoins under the Genius Act presents an opportunity for consumers to have an option to go outside of the traditional banking system to take custody of their money, which is what I'm a big advocate about in Make Your Wallet Your Bank, my free guide. I talk about the fact that there is a toll booth economy within the banking system where both consumers and merchants are hit at every turn with fees. Fees if you don't have enough money in your bank, fees to move your money, fees to receive your money. All of it extracts from the consumer, not to mention what happens to businesses. Businesses have to suffer sometimes 3.5% in merchant fees every time a consumer swipes a card at the point of checkout. And then they have to wait multiple days to get their money while that money sits in float and earns interest to the banks. The businesses have to wait to meet their bottom line. And there's a better way. Part of that better way is fully regulated stablecoins. So for weeks, if not months, we've been talking about the full frontal attack by the banking lobby against stablecoins. Primarily, they are opposed to the ability for consumers to earn passive yield on stablecoins. And there's been a lot of back channel conversation, backdoor debating and arguing about this between the banking lobby, the crypto sector, and members of Congress. I've been very vocal that the consumer has pretty much been locked out of that conversation. But in any event, they finally reached what they believed was a meaningful compromise. Senator Tillis and Senator Alsobrooks both publicly endorsed a version of the yield restriction on stablecoins. Let's get to the backstory. Remember, we had the Genius Act pass last year, which opened the door for fully regulated digital dollars, stablecoins under the Genius Act. They have to obviously meet very strict requirements with respect to capitalization. And one of the components of that legislation was that stablecoin issuers cannot pay yield directly to consumers. But what the bill left open and what has caused so much debate on the Clarity Act has been, where can consumers get yield outside of earning yield directly from issuers? Coinbase has been one of those big avenues. We have seen through the legislation and the process that Coinbase has been very much opposed to limiting rewards. Remember, they enjoy a very, very lucrative business relationship with Circle and USDC, where consumers who custody their USDC on Coinbase earn very generous yield, or what they call rewards. The banking lobby doesn't like this because they're concerned that it will limit their ability to retain depositor money. It will hurt community banks and their ability to lend out money, and it will cause a flight of deposits. As much as they've tried to generate panic around this, they've largely failed. They ginned up a bunch of statistics and tried to put out worst case scenarios as far as what that would look like for the flight of depositor money. But that's been pushed back on pretty soundly. Even the White House came out and called BS on that because it was really literally just a stacking of worst case scenarios to where they got to that number. So this debate has been going on for a while. The banks don't want people to be able to earn passive yield on stablecoins by just literally parking their stablecoins in Coinbase or in other exchanges. And of course, there's also DeFi, the ability for consumers to earn yield in other more creative ways on stablecoins. The banks have been very vocal about trying to kill this, and Senators Alsobrooks and Tillis proposed, okay, fine. They would have a rewards program which would not allow passive return. You'd have to demonstrate some kind of activity-based return. There is a lot that is still up for debate on this. But unfortunately, on Mother's Day, the banking lobby put out a letter calling for all banks to do another full court press on Congress to try to basically eliminate any and all rewards on stablecoins. That really was interesting timing and just indicative of how tone deaf the banking lobby is to giving consumers choice and freedom of choice. In any event, that drew some pretty extensive criticism. If you roll back to when Tillis and Alsobrooks announced this compromise in the draft language of 404, I believe it's Section 404 of the Clarity Act, the banking lobby pushed back and said that that's not enough. They got it all wrong. And Senator Tillis pushed back and basically told the banking lobby, enough is enough. We're just going to have to agree to disagree on this thing, and banks are just going to have to suck it up and move on and accept that stable coins are going to have certain avenues for rewards. Well, like I said, on Mother's Day, that wasn't enough for the CEO of the ABA. He put out a broad call to action, and that triggered another response from Senator Bernie Moreno. He issued a pretty scathing response. While Americans were celebrating Mother's Day with their families, the CEO of the American Bankers Association sent a frantic alert to every bank CEO in the country, demanding, quote, immediate engagement, end quote, to lobby senators and kill stablecoins that would finally let everyday Americans earn real yields on their own money. Let's pause for a second before I read on with this and just look at what we are witnessing. The banking lobby has enjoyed unfettered, pretty much total control over the narrative when it comes to this stuff. They have had access through their lobbying groups to the congressional people who shape policy, and they've been very influential in that process. And now, on this particular hill, they chose to fight to the metaphorical death on this issue, and Congress has pushed back on them and said, enough is enough. Congress has essentially marginalized the banking lobby when it comes to their position on stablecoins, and that cannot be underscored as being a significant event. Going back to this incredible tweet, which, of course, I love the headline of this tweet by Bernie Moreno, the banking cartel is in full panic mode. That is pretty on point with what I've been saying. A, yeah, they're a banking cartel, and B, they're trying to protect their monopoly against how consumers custody and move money so that they can preserve their fee extraction business model. He closes, or he goes on to say in this post, the line in the letter sticks out. I should say this line in the letter sticks out. Quote, we believe committee members may not be fully aware of the risks to the economy by the stablecoin loophole, end quote. Senator Moreno pushed back to the CEO of the American Bankers Association and his call to action by saying that's both intellectually dishonest and simultaneously demeaning. Think about that, folks. Sitting senators on the banking committee have basically told one of the biggest banking lobbying groups in the country to pound sand, and offended by the fact that they would insinuate that senators don't get, after all the backroom negotiations, after all the dialogue, that they just don't get it. That demonstrates a level of elitism that didn't stop there. It makes me wonder who in the world is working comms for these lobbying groups for the banks, because they have absolutely fumbled the bag on this thing. Not only did they double down with these increased calls for actions, which, by the way, flooded Congress with, I think, another 8,000 letters in opposition. So we evolved from not only trying to limit rewards to basically trying to kill it, which is what their proposed markup or changes to that section of the Clarity Act would do. It would essentially eliminate any and all opportunity for consumers to earn any kind of reward or yield on their own money. Stunning. But then they doubled down and said that we don't want to debate this on X. I guess this was in response to Senator Moreno's scathing post. And again, that only caused more backlash from people, because X is the water cooler. X is a major platform where consumers get to engage with these groups, but these groups don't want to engage back. They'd rather have their conversation in back channels, and they'd rather have their conversation when flooding the zone with letters directly to these sitting Congress people than engage publicly on X about these issues. Again, that backfired incredibly badly for the banking lobby, but they continued to double down. More desperation, indicative of exactly how threatened their fee monopoly was by any potential for stablecoins to be integrated into the financial system. They continued to double down, and then they put out yesterday, or maybe Wednesday, they put out this gem. They pivoted from full-on panic mode about consumers being able to earn rewards on stablecoins and how that would destroy community banks and cause a flight of deposits, because heaven forbid consumers have choices, and maybe that puts pressure on banks to cut their fees. But then they doubled down with this gem, where they noted that on-chain money laundering ecosystem grew from 10 billion in 2020 to over 82 billion in 2025. Without robust AML safeguards, crypto significantly diminishes the effectiveness of economic sanctions, undermining American leadership and our national security. I had to call total complete bullshit on this one as well, because what they are saying here is not altogether correct and is kind of gaslighting. Because yes, there's been an increase in the amount of on-chain money laundering, but they ignore the fact that banks still are predominantly the number one facilitator of money laundering. Not that they're complicit in it, but obviously wire transfers and banks do facilitate upwards of trillions of dollars in money laundering. There's no denying the statistics. It is overwhelmingly the dominant way that money gets laundered. Yes, crypto is starting to increase in the use and facilitation of money laundering as a technology. However, the 2020 to 2025 increase compared to what's being laundered via banks is a drop in the bucket. And it is incremental increase because we're seeing an incremental increase since 2020 in the adoption of technologies that include blockchains. So it's no surprise that if you have increased adoption of blockchain technology, you're going to have increased abuse of blockchain technology, but that should not be in and of itself a justification to do away with blockchain technology. And that just shows you the level of desperation on the banking lobby side to try to kill stablecoins, because they view stablecoins as being some kind of a conduit. Now, I wrote about this extensively in my book, Make Your Wallet Your Bank, because and for many of you who may not know this, I spent, I've been for nearly 30 years a criminal defense lawyer. I've defended many money laundering cases, many violations of the unlicensed money transmitter statute, and I've seen firsthand the impact of money laundering on both the victims through victim impact statements. Seen a number of people go to prison for money laundering. And the thing that's fascinating about the entire process when you get to see it from the ground floor in the courtroom is, as I look at all the evidence of money laundering, and I see that the banks obviously filed their suspicious activity reports, they comply with the anti-money laundering requirements, they comply with the Bank Secrecy Act, they check their boxes. The defendants go to prison for money laundering. The victims try to recoup their losses in restitution from those defendants. But the irony of all of it is the banks get to keep all their fees. So the banks are the vehicle that is predominantly used for money laundering. They get to retain their fees, like wire transfer fees for processing those transactions. They don't have to give those back or do anything with respect to that. They just have to file their suspicious activity reports, check their boxes in their compliance office that they complied with anti-money laundering standards, but they get to keep all their fees. And that irony isn't lost on me. So another aspect of this that's very frustrating is the fact that banks have not been really genuine in their desire to seek a compromise on these issues. I've maintained for a long time that they have wanted to kill stablecoins, and that all this sideshow conversation about limiting yield has basically been a stall tactic. And I think the desperation that came out with that anti-money laundering post from the banking lobby only confirms that. Now, this is what led us up to the Senate finally tabling the Clarity Act for a markup. They released 309 pages of the bill. Of course, all the crypto nerds jumped in and all the crypto lawyers jumped in and gave their feedback, talked about the concerns with respect to decentralized finance, with respect to potentially prosecuting code developers for the potential illicit use of their code, which I find to a certain extent a little bit ridiculous, because it is like prosecuting the hammer company, the manufacturer of a hammer, because burglars could use that hammer to break into your house, and the manufacturers know that burglars could use their tool for illicit purposes. That's kind of tantamount to this, and that's triggered a lot of debate. And obviously, it's not a perfect bill, as I said, but it got teed up for a markup. And I watched it yesterday, and I predicted that we would see Senator Warren come out and absolutely be unhinged. Her performance yesterday was very, very predictable and to be expected. But I want to play a particular clip of her performance yesterday, because I think it is indicative of just how much she despises crypto and how much she has drawn a line in the sand that she does not want blockchain technology in any way, shape, or form integrated into capital markets, the banking system in general. And she's completely become an island unto herself. Let me play the clip and then we'll talk about it, because it really is stunning.
Activities that taxpayer insured.
Let's rewind that. It's just that good.
Crypto-related activities that taxpayer-insured banks are permitted to engage in. Wow. But this one falls far short. Under this amendment, banks would be able to transact in decentralized finance, lend against crypto as collateral, own crypto directly, trade crypto derivatives, and more. What could possibly go wrong? Why are Republicans trying to divert Americans' deposits away from small business lending and mortgage lending? This just makes no sense. If the bill passes, even with this amendment, the next crypto crash could bring down the banks as well and bring down the entire economy. Let's strike this section instead of trying to tweak it along the edges and pretend that that fixes this problem.
Well, she lost on that argument as well. The thing that I think is important to note about her performance yesterday is you can literally see the utter disgust that she has for this technology in the way she described decentralized finance in such a dismissive way. Yes, DeFi has had a lot of problems of late. Cannot ignore that. But what she's essentially proposing is completely destroying this technology, completely driving this technology offshore, and it's not going to go away. It's just going to go into completely unregulated environments. And one thing I think we can take away from her performance yesterday is that she has essentially become an island unto herself. Her views are so anti-crypto, so anti-stablecoin, that she even goes far beyond what traditional finance wants to see happen with this technology, and even the banks. Look, the banks, and I'm not anti-bank. I think banks serve an important purpose. However, I think banks as we know them need to be completely disrupted. And I think stablecoins do that to the benefit of the businesses and consumers. However, even the banks are not as far in the extreme that they would want to completely deny capital markets and banks access to digital assets. It's insane what she's proposing. She's essentially gone so far off the fringe that she's an island unto herself. And I think she's lost the narrative. I'm going to be putting out a piece kind of talking about that today, because I think and I use this example in the piece, if she were in power back in the late 1920s, early 1930s, when emerging capital markets and the ability for consumers to invest in capital markets, stocks, equities, started to come online, it was much like the crypto sector is today, the quote, Wild West that Elizabeth Warren describes. And there was a lot of fraud. There was a lot of insider trading. There was a lot of pump and dump. But we still pushed on because it was something that the consumer should have access to, should be informed about, and should have regulatory rails built around it. She's not proposing regulating crypto. She's essentially proposing completely killing crypto. And her behavior yesterday made that very clear. And if she would have been in power back in the 1920s and 30s, I don't know that we would have had the Securities Act. I don't know that she would have tolerated allowing consumers to be able to choose for themselves where they can invest their money. Look, she's been an advocate for the consumer with respect to consumer and personal bankruptcy. She caught her real stride and got elected based on the financial crisis and the advocacy for protecting consumers against excessive fees and so forth. And I bet if I sat down over coffee with her and we talked about what's in my book, Make Your Wallet Your Bank, the fact that I'm also fighting for consumers, we probably would agree on a lot of things. But where I think she's lost her way and where I think she's lost the narrative completely is that she presumes that consumers are not able to safely make choices for how they spend and custody their own money. What she demonstrated yesterday was that she's anti-self-custody, she's anti-decentralized finance, she's anti-integrating any of this into the capital markets, meaning that consumers should have no choice. She's anti-privacy because obviously a lot of this, the notion of self-custody is very important. And I think that that essentially has put her out on her own island. Not even her own colleagues can vote with her. She lost on several amendments that she opposed that were proposed by Senator Loomis that had broad bipartisan support. And every time they came up, her vote no was louder than anybody else's. And it only demonstrates that she has pretty much isolated herself and exposed herself for what she is, completely anti-crypto. So for those who say, look, the Clarity Act is bad for crypto, bad for stablecoins, I'd push back in one respect and say, hey, just like we needed reform and legislation to get integration of capital markets back in the wildcat days, the Wild West days of stocks before they were regulated, if we're going to see this stuff get adopted by traditional finance, which is the next leg up for growing this asset class, then it has to be legislated and regulated. If we don't get this done this term, with a White House that is really behind it, a Congress that has Senator Loomis, Scott, Alsobrooks on the left side of the aisle, Tillis leading the way and pushing this innovation forward, we stand to lose this window. Because once Senator Warren, if the midterms flip, and frankly, the situation is not looking good for the midterms for Trump, if the House and Senate should happen to flip and Warren gets the gavel and controls the banking committee again, well, she tipped her hand yesterday and told you exactly what she thinks of this technology, and she believes it should be completely walled off from capital markets, from banks. I mean, even the banks don't share this extreme view. And it tells you that if she were to have control of the gavel again, that is exactly how she would approach digital assets. Reinforces why my good friend John Deaton, who ran against her, unfortunately, would have been far better for that seat in Massachusetts had he won. And now that we are stuck with her, even in the minority position on the banking committee, you can see just how vehemently she opposes digital assets. And it's unfortunate that John could not defeat her and could not have changed that power dynamic. But again, if Clarity Act doesn't pass and we are left with simply the regulatory agencies, CFTC and SEC, who have obviously very crypto positive chair people in power, if that paradigm should shift in the next election cycle, well, then everything that's been built is in jeopardy. And you can tell by the market right now that everyone's on the sidelines waiting to see if this thing gets over the finish line, because traditional finance and the institutions, they're not going to come into this stuff in full port until they know from their lawyers that they can safely do this. And the only way that they can get that assurance from their lawyers is if this is baked into legislation and if this is obviously clearly regulated. Otherwise, we stand to go back to the Gensler era of overzealous regulation by enforcement actions, and that would stifle innovation and chase this stuff overseas. So we'll continue to monitor what is happening with the Clarity Act. It largely has no impact on what's going to happen with stablecoins, because all of the stablecoin legislation that really is critical for the advancement of this stuff is in the Genius Act. And if you are looking at how much stablecoin innovation is happening right now across Circle, across Stripe, across Visa, even Western Union is adopting stablecoins, then you know that this stuff is coming. And Clarity Act helps in giving more legitimacy and more regulatory clarity to the overall blockchain infrastructure. And that's important for the continued development of stablecoin integration. But stablecoins are not going away. That's why I host this show every Friday at 9 a.m. Eastern. That's why I wrote Make Your Wallet Your Bank. And in closing, I'll tell you again, if you haven't downloaded it, and yesterday I hit a milestone, I'm very happy to report, over 420 subscribers. And I appreciate that. And I think that's a pretty big accomplishment considering I launched this free guide back in March. Really excited to see the response and the momentum. And I'm going to continue to deliver to my community. I'm going to continue to deliver education. Look, you know that there are fees being extracted and there's a better way, but you need to understand how to jump into that ecosystem and how to safely interact with this stuff. And that's what I'm here for. That's the value I want to give. So if you haven't downloaded your free copy, go to my profile, go to any of my links on my X account or on YouTube, and you'll see a link to download your free copy of Make Your Wallet Your Bank. I will continue to cover this stuff and continue to give you a real assessment of what's really going on here and how it can benefit you as consumers and merchants. We'll continue to monitor what's going on with Clarity Act. I think that's enough for today. Thank you for coming to my TED Talk. Again, if you missed the live broadcast, you can download this. It'll be available on YouTube, Spotify, and Apple iTunes. I hope everyone has a wonderful weekend, and we will continue the conversation next week. Thanks, everyone, for joining in.